Hey everyone, welcome back to Corporate Decoder, the place where we unravel the stories hidden within the financial world. Today we are diving into what seems like a company still in its infancy yet already making some serious moves. Get ready because this report is full of actions happening after the period they are reporting on. We are looking at Insight Digital Partners, the FECL quarterly report for the period ending the 30th of September 2025. Now this is a bit of a unique case. Insight Digital Partners, the second, is what we call a special purpose acquisition company, or SPAC for short. These companies are essentially shells created to raise money through an initial public offering, or IPO, with the sole purpose of finding and merging with another company. Think of it as a company looking for a business to buy or merge with. So for the most part of this filing, we'll see a lot of preparatory work and then a very major event happening right after the reporting period. Let's peek at their balance sheet as of the 30th of September 2025. Right away you can see that their assets are quite small. They have just a little over $3,000 in cash and about $225,000 in deferred offering costs. Deferred offering costs are basically expenses related to getting ready for their IPO or initial offering that haven't been fully recognized yet. On the other side of the ledger, their liabilities are much higher. They have about $107,000 in accrued offering costs and another $140,000 related to a promissory note from a related party which is likely their sponsor. This means their liabilities are significantly larger than their assets at this point, which is pretty typical for a company in this stage as they are still raising capital. Looking at their statement of operations, things are just as expected. For the period from the 11th of July 2025, which was their inception up until the 30th of September 2025, they incurred a net loss of about $51,000. This loss primarily comes from general and administrative costs, which are the normal expenses of running a company, even if it is not actively operating yet. This is perfectly normal for a SPAC before it has completed its business combination. Now let's talk about the ownership structure and how they got started. On the 11th of July 2025, Insight Digital Partners, the second, was formed in the Cayman Islands. The sponsor, Insight Digital Partners Sponsor LLC, was issued Class B ordinary shares for an initial investment. Most importantly, these Class B shares are usually held by the founders and sponsors, and they typically convert into Class A shares upon a business combination. Here they issued 5.75 million Class B shares for a payment of $25,000. This is a common way for sponsors to get their stake in the company, which is then subject to certain conditions like forfeiture if the underwriter's option isn't fully exercised. We also see an administrative services agreement with their sponsor where the company will pay up to $30,000 per month for office space and administrative help starting from October 2025. The real action begins right after the reporting period. On the 30th of October 2025, the company had its initial offering. They sold 17.25 million units at $10 each, generating a massive $172.5 million. Each unit included one Class A ordinary share and half of a redeemable warrant. This offering also included an over-allotment option where underwriters bought an additional 2.25 million units. This significantly increased their capital right after the reporting period. Simultaneously with the initial offering, they also conducted a private placement selling 5.45 million warrants to their sponsor and the underwriters for $1 each, generating another $5.45 million. These private placement warrants have similar terms to the public ones but come with extra restrictions. This section is crucial because it details what happened immediately after the fiscal quarter ended. The company's initial public offering was a major event. On the 30th of October 2025, they completed their IPO selling 17.25 million units for $172.5 million. They also sold 5.45 million private placement warrants for $5.45 million. This means a large portion of the proceeds from these sales was placed into a trust account. This trust account is where the money is held until a suitable business combination is found. The company also paid substantial underwriting fees with $3.45 million in cash and a hefty $6.9 million in deferred fees that will only be paid if a business combination is successful. Following the closing of the IPO on the 30th of October 2025, an amount of $172.5 million from the net proceeds of the unit sales and a portion of the net proceeds from the sale of the private placement warrants was held in a trust account. This trust account is there to protect the investor's money until a business combination is completed. So what does this all mean? Insight Digital Partners II is a classic SPAC. They raised a significant amount of capital through their IPO and private placements right after the reporting period. Their financial statements as of the 30th of September 25 show them as a company in formation with minimal assets and liabilities related to their startup costs. The real story here is not the balance sheet at the end of September, but the massive capital infusion and the strategic pivot that happened in late October. They now have the funds to go out and find a target company to merge with. The success of this SPAC will entirely depend on their ability to find a good business to combine with and execute that deal smoothly. The substantial deferred underwriting fees also put pressure on them to get a deal done, or those fees essentially evaporate. Now, looking at this broader picture, Insight Digital Partners, the second, is in a critical phase. They have a war chest of capital and a ticking clock to find a business. Their strength lies in the significant funding they have secured, which gives them a wide range of potential targets. However, their main weakness is the lack of operational history and the inherent risk associated with SPACs, that they might not find a suitable business to merge with within their timeframe. The market for SPACs has been volatile and investor sentiment can shift quickly. The key opportunity here is to identify an undervalued company in a growing sector and bring it public through a combination. The risk is that they might overpay for a target or that market conditions change unfavorably, making the deal unattractive to shareholders. In conclusion, Insight Digital Partners II has successfully navigated its initial public offering, completing a significant fundraising round. Their financial health is poised to change dramatically with the completion of their business combination, which is yet to be determined. The coming months will be crucial as they work to find and secure a merger partner. We will be watching closely to see if they can deliver value to their shareholders. Alright, that is our breakdown of Insight Digital Partners, the FI's latest filing. What is your take on these numbers and what they signal for the company's future? Do you think SPACs like this are a good investment strategy? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description for more discussions. Thanks for watching. See you next time.